everyone. Welcome to today's webinar. I just want to do a quick sound check here, make sure everyone can hear me okay. If you wouldn't mind just typing in yes in the chat box, just so I could make sure sound check is okay, or let me know if I need to make any adjustments. Hello, everyone. Welcome to today's webinar, our tips for professional traders when preparing 2019 tax returns. We are very happy to have you join us. We try to provide a lot of different topics and educational assistance for our traders and resources. This is one of our highly anticipated presentations and one of our most viewed as well. We're happy to have Robert Green from GNM Trader Tax and his tax team here available to do this presentation. Mr. Green is one of the forefront professionals in trader tax law and trader tax information. So this is some very valuable information for new traders or even professional traders that have questions on how to prepare tax returns and how to file. So we will get started here. We'll be able to take questions as they come, but certainly we're going to have a section at the end for some questions. So try to hold them at all possible for the end of the presentation here. Just quickly, we have a quick disclaimer. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or recommendation to buy, sell, or holding security or contract. Since we don't know everyone's investment objectives or risk tolerance, we're not endorsing any specific trading strategies. Security, derivative, and futures trading involves a substantial risk of loss, is not suitable for all investors. Each investor must consider whether this is suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Line Brokerage LLC. Line Brokerage LLC is not affiliated with these third-party market commentators, educational service providers. Data, information, and material are provided for informational, educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Again, investment decisions made by the users through such contacts is solely based on the user's independent analysis, taking into consideration of financial circumstances, investment objectives, risk tolerance. Line Brokerage does not endorse, offer, nor recommend any services or commentary provided by any of the market commentators, educators, service providers, or any information used to execute any trading strategies solely based on the independent analysis of the user. Thank you. For more information on a demo of the Lightspeed trading software or opening an account with Lightspeed, Division of Line Brokerage, please contact us. You could email me directly. My name is Rob Lifson at rlifson@linebrokerage.com. Feel free to visit our website, request a demo of our software, looking to open an account and have questions, feel free to email or call us. And please utilize the resources that we provide on our website. A copy of this presentation will be available on the website along with our previous presentations and some upcoming presentations as well on our resources live webinars page, so you can register for upcoming events as well. Additionally, everyone please remember, one lucky attendee of this webinar will be randomly selected to win a Lime duffel bag. So you will have to stay to the end of the presentation, so we have the raffle. So just keep that in mind. We want you to stick around for your own information and benefit, but as a bonus, we are raffling away one lucky duffel bag. Just so everyone's aware, if you are a Lightspeed account holder, you can log in and go to the Lightspeed website and go to the tax documents section, My Account Tax Documents. This is where you are going to pull your tax information. The 1099 will be available on that section. Okay, without any further ado, we are going to present our topic here. Joining with Robert Green is Darren Neuschwander and Adam Manning from Neuschwander and Manning LLC. They have long time experience in this field. We're happy to have them. We've had them for a couple years. It's always been one of our most popular presentations. So guys, really take in and listen what they have to say, and even contact them for additional information outside of the presentation. They do host services and provide consultations as well. So I'm going to shift over the presentation here, give Robert the mic and let him take over and get started. So Robert, I am happy to make you the presenter, and away we go.
Thank you, Rob. Appreciate it. Let me just get set up here. Okay, we're covering tips for professional traders. That's shorthand for active traders on a daily basis, retail trading your own funds, not customers. So tips for traders with trader tax status, we call it, when you prepare your 2019 tax returns, which you should be doing right now. If you haven't done that with our team already and given us the information, you can probably figure you're going to be doing an extension, and we're going to talk about that as well. Here's a current photo of me, managing member of GNM, Green, Neuschwander and Manning, and CEO of Green Trader Tax, which is the publishing company. And here are my great partners, Darren Neuschwander and Adam Manning. Darren's the boss of tax compliance. That's our biggest business. Adam is his co-partner there. Darren's a co-managing member with me running the firm. So we have great people, great partners, and lots of great CPAs working for us. You can see the roster on our site. We're dedicated to the needs of traders and investment managers. Tax compliance, preparation and planning, accounting for those trades if you have trouble with the 1099Bs, consultations with me or Darren about trader tax status. Do you need an entity? Should you elect 475? If you do need an entity, we help set it up. And if you have trouble with the IRS or state, we defend you to the bitter end. We have a virtual communication process with best practices, secure and encrypted, working with clients nationwide, worldwide, in the cloud. You don't have to come into an office. We were the first to do it with the website, with everything, doing that type of model. I see all the storefronts now are going in that direction. Thanks, Rob, for your educational disclaimer. Ours is similar. If you want one-on-one advice, you need it. You need to pay for it with us for tax advice. We're not financial planners. We're not investment managers. And we at the Green Companies, we're not affiliated with Lightspeed. We're just providing this webinar. We're going to talk about several new and revised tax forms, just a couple of minutes on that. We're going to really dig into how traders, and here's the key, eligible for trader tax status in the business of trading. That's what opens the door to maximize business deductions, home office expenses, startup costs, and there's critical tax reporting strategies. So many Lightspeed traders, they could be day traders, swing traders, trading on a daily basis, full-time or part-time. They could be eligible to claim trader tax status for 2019. There was no election required for the status. You can add a Schedule C for all these expenses, so listen up. Plus, you might want to make a 475 election for this year, especially after a volatile Q1, where some traders incurred large losses and want ordinary loss treatment. They don't want a capital loss limitation. So that with TTS, you get the business expenses, you get the election, and you could also do entity benefits for retirement and health. Now you got your 1099Bs. Now you're getting your tax documents. They're different. You have various brokerage firms that you work with. The reporting is a little different. They're all following the rules from the IRS. It's very basic rules with a very narrow view towards wash sales on identical positions per the one account. The IRS has different rules for you, the taxpayer. It's apples and oranges. They want substantially identical positions across all your accounts. So if you're a typical investor with one account and you just trade equities, maybe you can just use that 1099B. But if you have equities and options, which are substantially identical, and you have multiple accounts, including your spouse, married filing joint, IRA accounts, then you really want to think about other reporting strategies, including software. And how to deal with all that requires a lot of experience that Darren and Adam have, and our team has. Now, there are some common errors that a lot of traders make on tax returns, including local accountants who make them. They intuitively treat it like another type of business, but it's not your everyday business. It's almost the reverse. It's a very unique business structure and arrangement that requires key tax reporting strategies so you don't have a red flag with the IRS. Now, again, it's late. So you want to focus on what you owe the IRS and get extensions filed with the elections that are due on those same dates. Don't try to rush a return in that could get an amended 1099B that could have problems. it's a two-stage process. You got the extension and then you got the final due date. That's how sophisticated, complicated, rich taxpayers deal with it. You may not be rich, you may not be sophisticated, but you have a complicated business trading and you need more time. So it's a revised two-page 1040. They said it's a postcard. That's how they sold tax reform. They were giving corporate America really big breaks, and for the everyday individual, they said it's simpler, it's easier. It's a two-page thing with 6 schedules. People balked at that, so now they've fattened up the 1040 again, and now there's 3 schedules. So get familiar with Schedule 1, 2, and 3. They part of making taxes simpler was to just say, listen, itemized deductions, they take a lot of work. People put a lot of time and effort into it. It's not productive. Let's just increase the standard deduction and wipe out a lot of itemized deductions. Well, they wiped out the investor deductions, many of them. They suspended, so it's not wiped out permanently, they suspended until 2026 certain miscellaneous itemized deductions subject to the 2% floor. That's where you deducted the job expenses, your investment fees and expenses, and your tax compliance fees and expenses. Our clients don't worry about the tax fees because they're traders with TTS business treatment and they deduct it as a business expense. And traders, they're not so worried about not having investment fees and expenses because they have trading business expenses, which are far better from gross income. The only investor-related itemized deductions left are investment interest expense, your margin interest, limited to investment income, otherwise it's a carryover, and your stock borrow fees. Everything else, kiss goodbye. If you're an investment manager and you have separately managed accounts paying you advisory fees, your clients can't deduct those fees anymore. So you might want to have a hedge fund with carried interest where you get a profit allocation instead of incentive fees. People have not fully absorbed these changes, and it hasn't really hit the industry enough yet. I think people are still waking up to it. So Darren Neuschwander, you told me there's a new question on Schedule 1, which is one of those 1040 schedules about virtual currency. And again, Darren's my co-managing member, boss of tax compliance. He knows a tremendous amount, incredible bio. Check it out on our website, involved with the CPA task force, specifically on cryptocurrency right now. Darren, what's the new question and the implications?
Well, there's a new question for 2019. It's on the individual return. If you have to file a Schedule 1, which most taxpayers will have to file a Schedule 1, especially if you're a trader, because you're going to have either capital gain or loss or ordinary gain and loss treatment. So at the top of Schedule 1, now it says at any time during 2019, did you receive, sell, send, exchange, or otherwise acquire any financial interest in virtual currency? And you have to answer that yes or no. And a word of caution, based on what a recent announcement that came from one of the head of the IRS is, if you had any of those activities, even if you just basically acquired any type of cryptocurrency and did not sell it, you better answer that question yes. So even if you don't have anything to actually report on your tax return of a sale of a cryptocurrency, you still better answer that question yes, because if you're ever involved in an IRS exam or audit and they find out that you did have cryptocurrency and you answered that question wrong, they've already issued a very strong warning against that. So word of caution, just make sure you're answering that question. So any type of virtual currency, be aware of it. There's been a lot of back and forth also. If any type of gaming cryptocurrency, such as if you have some teenagers in the house that maybe play Fortnite and maybe they buy some of the cryptocurrency involved with that, that can be potentially classified as a virtual currency, but then the IRS last week changed their mind, and it wouldn't surprise me if they change it back again. So there's a IRS website. You can just go to irs.gov and type in frequently asked questions, and you can see everything about cryptocurrency that the IRS has released to date. Encourage you to look at that and make sure that you're picking all of your transactions up. And again, make sure that you take a look at this question and make sure you answer it accordingly.
Thanks, Darren. Adam Manning, our other partner, are the changes to tax forms, besides this question that Darren just covered, are they really substantial changes, or are they mostly cosmetic, for seniors, bigger type, moving this question from one form to the other? There are some new forms here or there, but is it major substantial changes or cosmetic?
I would say it's mainly cosmetic. As you said in the previous slides, the 2019 tax return kind of backtracks a bit from the 18, reducing the schedules and moving more information back to the face of the 1040 on the actual 1040.
So if someone's familiar with 2018, with the major changes, 2019 is not that big a change.
Correct.
Okay. Now let's get into the heart of a good area to save money: deducting business expenses, startup costs, and home office expenses. Traders eligible for trader tax status, TTS, can include a Schedule C for these business deductions. Now, many traders don't claim the status when they're entitled to, or they claim it when they should not, and that's potential trouble with the IRS. The IRS does not require an election for TTS as they do for 475 mark-to-market accounting. Those are related but separate, and a lot of traders and accountants confuse and conflate the two. So the TTS gives you many benefits. The first is business expense treatment, sort of like graduating from undergraduate university, from college. Not everybody wants to go to Section 475 graduate school. That you got to apply for. So if you're not sure if you qualify or not, click on this blog post and come over to our website. If you want, I can give these slides to you, Rob, if you want, and you can publish them along the recording alongside if people want them. So you want to deduct the TTS expenses on Schedule C. If you trade an individual account and you're eligible to claim it, you just add the Schedule C to your tax return. Now, if you tell your local accountant to do that, your local accountant may say, oh, good, we can put the trading losses there too and deduct those too. Wrong, that's a guaranteed audit. Deduct your business expenses, startup costs, and home office expenses only. A TTS trader does not report revenue or cost of goods sold on Schedule C. It's expenses only. Your trading gains and losses are going on other tax forms, and there's a whole bevy of forms. So your individual return has Schedule C expenses, gains, and losses on all these other forms and all these other areas. We tie it all together in footnotes. So you're using Form 8949, and a lot of your 1099Bs mention that form. That's for your securities. You make your wash sale loss adjustments. You report every trade separately, and you consider software to download the trades and to help you with that if the 1099B is not up to snuff for your needs. Now, if you're trading futures and other 1256 contracts, those are not securities. Those don't go on 8949. They go on Form 6781. In a summary amount, you pick that number right off the 1099B. That's reliable. Aggregate profit or loss after it's marked to market, after they put in the unrealized gains and losses at year end and backed out the unrealized gains and losses from the prior year end. That's real easy to handle, very easy to deal with. The 8949 can be a real challenge with wash sales, but the 6781 is a breeze. Now, if you're trading Forex, then you're going back to that Schedule 1 where that currency, the virtual currency question was. That's where your other income line is for the Forex ordinary gain or loss. Summary reporting using the broker P&L. There is no 1099B for Forex. Now, remember, your brokerage commissions are included in the trading gain or loss numbers on the 1099B. You're not separately reporting the commissions as a business expense or a Schedule A item. That's included in the gain and loss numbers. So back to the Schedule C, we got the tangible personal property up to $2,500. So you buy a computer for $2,000, expense. Buy the computer for $5,000, that's more than $2,500. Take 100% depreciation either through Section 179 or bonus depreciation. Section 179 requires income from trading or wages. You can't use full 100% depreciation, use regular depreciation. It's very attractive. The new tax law really beefed that up. Go back and capitalize some of your startup costs to investigate and inquire, like education. Go back 6 months before TTS inception. Let's say you started trading January 1st, 2019. You go back to July 1st, 2018 to capitalize startup costs, those trading school amounts. Write off the first up to $5,000 in 2019, the first year. The same for organization costs if you had a new entity that you set up with lawyers and accountants. So remember, education expenses, which can be a big number for new traders, you pay it, you take your classes. If it's before the commencement of TTS, and that's a good idea to learn what you're doing before you start the business, the TTS doesn't commence until the live trades hit 4 trades a day, 4 days a week. Before that, you're paper trading, you don't have TTS. So that's where you realize that pre-business education's not deductible at all. So let me try to squeeze it into Section 195 startup costs. There's publications, market data, professional services, chat room, mentors, coaches, supplies, phone, travel, seminars, conferences, assistants, consultants. Darren's going to give us some stories in a few minutes about working with traders to give you a live story, which is more palatable than me just rushing through these slides. Now, the home office expense is a big one for traders. And I love the way Darren explains that it's really, you're converting personal expenses into business expenses. It's not new cash you're outlaying. Your margin interest, you don't have to be limited to investment income. You can deduct it even if you had trading losses. And for you short sellers, those big stock borrow fees, you don't want an itemized deduction, which could be subject to haircuts and issues below the line, AGI issues. You want it above the line from gross income. Your internal use software for automated trading, you build your own systems. You want to write that off. Home office is one of the most significant deductions. It requires trading gains to unlock it. So you got your mortgage interest, the real estate tax portions, they do not require income. And they help you get over that SALT limitation in the new tax law that would limited you to 10,000 on Schedule A. So you can get more of it on Schedule C. And the rest of those deductions for the home office, they require income. If you don't have it this year, don't say I'm not going to take it. Absolutely take it because you carry it over to next year. And there are some complications between the itemized and standard deduction. Time permitting, we'll cover some of those. So again, on the startup cost, you're going back 6 months. You're capitalizing. So you spent $15,000 in November of 2018. Your TTS started January 1st, 2019. You capitalize the $10,000 you spent. You write off $5,000 the first year, the other $5,000 over 15 years. So we like to add footnotes to our tax return because there's a lot going on here. You got the Schedule C expenses, which are a red flag. You got trader tax status, which the IRS may not understand. Their computers are not really set up to handle, probably still is the case. And how do you tie together all these strategies? Well, in the footnote, it explains the Schedule C that is expenses only. It explains the TTS law and how you qualify for it. Specifically, you had X trades, X frequency, holding period, right down the line in our content. It explains how the different forms are tied together and that you're a profitable trader. And it's really important to have these footnotes if you're going to do this on your own. So let me bring in my partners. I want to save more time. We got a 60-minute session. There's a lot of content here, and I want my partners to tell some good clients type stories. Darren, give us some examples of how you work with TTS trader clients like our clients to maximize their deductions for business expenses, startup costs, and home office expenses.
Well, anytime a new client comes to us, we have what's called a 15-minute new client evaluation. And in that, I'm trying to help you determine how much in trading related expenses that you may have. And some clients that come don't think they have a lot of expenses, but then when we start going through what they're doing on a daily basis, what they're utilizing. You have your computer, and so you're sitting at a desk. You may have office furniture. You're paying for your internet costs for your connection. So a portion of that can be a business expense. You may be watching CNBC or Fox Business on your TV. Well, okay, now we can take a potential deduction for that TV or maybe some of your cable bill. And then we start looking at the home office. What can we deduct there? And as Bob said, I mean, the home office is an opportunity to take what would normally be non-deductible personal expenses and convert a portion of that into a business expense. And what I mean by that is just think of your utilities, think of your pest control, your maintenance on your home. Those are non-deductible personal expenses. But if you qualify for as a TTS trader, you can take a portion of those non-deductible expenses and turn them into business expenses. And that's the advantage of the home office. The other reason why we strongly suggest the home office, if you have one and truly qualify for it, some people fear that it's a red flag. It's actually more of a red flag as a trader to not claim it. And the reason for that is it helps substantiate that you truly are in the business when you have a home office, because that's where you're doing all your trading from. In fact, I always give this example. We had a client that was audited. They lived in California. They were audited by the state of California, and they were trying to determine, did this client qualify for TTS? We went through the entire process, and the agent asked if they could actually do a visit to the taxpayer's home because they truly wanted to see their setup. And the client agreed to it. The agent came, did a tour, went into the home office, saw the 8+ monitors that she had in her home office and the setup and the fact that there was not a bed in there. It was truly where she was doing her business. The agent signed off on the audit, no changes whatsoever. The taxpayer truly qualified as a trader, which we knew they did to begin with. We just had to fight it to the end. So all of these things that we're telling you is things that we do with all of our clients to try to get them the most benefit and add value back to you so you get the deductions that you deserve if you qualify as a trader.
Thank you, Darren. Now, Adam, that all being said, that Darren talked about all these great expenses. If a client walks in the door and tells you that they had this, that, and the other, and it sounds very iffy and not clear, you're not going to accept it. How should TTS traders keep track of their expenses to impress the IRS and their accountant that it's all valid?
I normally suggest that clients, I guess, maintain them in any way that's comfortable for them. Some people prefer some kind of software, or they prefer just using Excel. Some people like to just sit at the end of the year and go through their credit, use one credit card, and then tally the expenses from there. But normally, just whatever they're comfortable with. And your next question here is about the accounting programs. We don't recommend that everyone use QuickBooks or Quicken or some sort of program, because sometimes that can be too confusing and almost cause more of a mess to clean up before we do the tax return. So for a lot of our clients, we basically just provide them with an Excel file to list in the organizer the expenses for the year. Or we also have what's called our Excel expense tracker, where you basically can maintain monthly your expenses as you go every month. And if you do it this way, at the end of the year, that part of your tax return is basically done. You can just provide me that file. I got all your expenses, and now we can move on to doing the trade accounting work.
Great. I know we always like the more organized solution because that's the safest way to go and the best way. Now let's talk about the second benefit of trader tax status, Section 475. We like to call it tax loss insurance, and it might provide a QBI deduction, although that's rare for traders. It's mostly the tax loss insurance. So you're exempt from wash sale loss adjustments on those 475 TTS trades, because those can lead to phantom income. With large tax bills, the IRS makes you defer a loss to the next year. No one wants that. And it also navigates around the capital loss limitation, where if you lose 50,000, you don't want to have to carry over 47,000 to the next year. You want the full 50 this year. Now, there is an excess business loss limitation. If you have a whopping loss with 475 and your expenses, and it's over 255 for other taxpayers, it's going to be an NOL, the excess, 510 for married. There's no more NOL carrybacks. The new tax law repealed those. They only let you carry them forward, and you offset the next year's income 80% of the time, which is not so bad. So you take advantage of lower rates, the lower brackets. So think of 475 as a way to get your losses on securities right away rather than having to carry it over. Now, if you're a profitable trader and you happen to hit everything right, and it usually doesn't go perfectly, you might get a 20% deduction for qualified business income. It's only on 475. It's not on capital gains. But here's the problem. If you make too much money, you price yourself out of it. So when we look at our client base, there's only a few few traders that actually get this benefit. So we're not going to spend too much time on QBI. We are going to cover the 475 election procedures because we don't want you to miss the boat. This is something you got to really focus on for April 15th. Existing taxpayer individuals. That means you filed a tax return the prior year that qualify for TTS and won a 475 election for 2020. They got to make the election by April 15, 2020 by attaching the election statement to their 2019 tax return or extension that they file with the IRS. You come to us, you say, Bob, I got a lot of expenses for 2019 and I have TTS. I saw all your content on that. I want to deduct the expenses and I want to deduct this big trading loss. You're in luck for the expenses. You're out of luck for the trading losses because you didn't elect 475 by April 15, 2019. That was the deadline last year. So focus on the deadline for this year. Now, if you're trading in a partnership or an S Corp that existed in 2019, your tax return is due March 16th, a month earlier, 16th because the 15th is on the weekend this year. So you got to do your extension and your election statement by March 16. That's coming up. That's right around the corner. Now, after these election deadlines, if you happen to set up a new entity, that's what's called a new taxpayer. There's a loophole for that. The new taxpayer, as opposed to the existing taxpayer, the new taxpayer can adopt the MTM 475 method by an internal resolution in their own books and records, not with the IRS filing, within 75 days of inception. So you didn't even know you were going to qualify for TTS. You weren't even thinking about 475. Those deadlines passed. You set up a trading entity in the summer, and that entity elects 475 within 75 days of inception. Now, let's say you did this for 2019 by April 15th. That was only step one. Don't forget step two. You have to complete the process with a Form 3115 filed with your 2019 tax return. And for that, you need Darren and Adam. That's a complicated form. It's intimidating. There's a lot of very legalese type questions, a 481A adjustment. I really think you should consider our help for that form because you don't want to botch it and jeopardize your 475. So questions for my partners. Darren, we've seen this before. With recent market volatility in Q1 2020, which is before the election deadline, we're going to hear from some of our clients, and we know there's a lot of TTS traders that are going to have incurred already or will incur, whether it's trading VIX options or indexes, long or short, the wrong way, substantial losses. They're going to have substantial losses. Now, could a 475 election help them? Now, by the way, if they're trading VXX, that's not a security, so 475 wouldn't help. But if they're trading most things that are securities, will a 475 help them tax-wise, and how so? Give us an example.
Well, as you mentioned, Bob, 475 is really basically fire insurance. It protects you when you have a downtime, and that's really what you buy insurance for. You buy insurance on your home, not for it to appreciate. You buy insurance in case something happens to it, you have a fire or theft. Well, that's what mark to market is. You need to consider formally electing that either by March 16th or April 15th, depending on what type of entity or an individual. But if you're already down for the year because of the market volatility, it's something you strongly need to consider making that election. And I caution you, if this is something that has happened to you, don't let those deadlines come by and miss you, because I've talked to a lot of new clients just preparing their 2019 tax return. And as Bob's has already mentioned, I mean, some people assume that if you qualify as a trader, you automatically get to use mark-to-market accounting. And that's just not the case. You have to formally elect it. And if you miss these deadlines, you're basically going to be out of luck. I had a client, potential new client, come to me just last week. She thought that we were going to be able to substantially help her. She lost $200,000 in trading stocks in 2019. She heard about trader tax status, was very eager to utilize it. And then when we got into it and I asked her the hard question, did you elect mark to market by April 15th of 2019? She said, no, I didn't know anything about it. And I had to be the one to unfortunately tell her that those losses are going to be subject to the capital loss limitation, and we're only going to be able to take 3,000 of it. She's now going to have 197 carried forward to 2020. So that's a word of caution to you, is if you are in a downturn for 2020 already, strongly consider making this election by March 16th or April 15th, and don't miss those deadlines. Otherwise, you may be in a similar situation of what I just described.
Don't leave it to your local accountant the last week before the deadline to ask about trader tax status in 475. They won't have time to think it, to research it, and to appreciate all the nuances. Thank you, Darren. Adam Manning, do some brokers use 475 reporting on 1099Bs? And if yes, is that safe? Aren't there issues with that?
Bob, yes, there are some brokers that do allow you to use 475 on their 1099B. So you just tell them and they report it using 475 mark to market without the wash sales and marking the positions to market. I would caution taxpayers not to do this because, as we said, to qualify to use mark to market accounting, you must qualify as a trader. So 1 year you may qualify and 1 year you may not. Irregardless, that broker's can continue reporting your 1099 on section 475. So that 1099 is not going to be correct for you in years that you do not qualify and do not have mark to market accounting. So you could have issues.
And I've seen some clients tell the broker they have it when they didn't have it. They didn't elect it on time. They tried to sneak it. That's what the IRS loves, to bust people who try to cheat on 475. That's the tax court cases. Thanks, guys. So we're going to talk about the QBI deduction very quickly. It was a big part of the new tax law for pass-through businesses. Trading is a pass-through business, and 475 is QBI income, but there's some really big thresholds. So if you're making income under the threshold, you might get it. If you're in the phase out range with an S corp, you might get a little. And if you're over the income cap, you get nothing. Manufacturers really get the benefit of this deduction, but service businesses, it's very limited, and trading is a service business. A lot of hoops to jump through. We're not going to spend really any time on this area because very few of you are going to meet the requirements for this, and we have the content on the website. So let's move on to the next set of slides on Form 1099B issues. This is a big one. You know, this has been a thorn in our side for a long time because the IRS rules for brokers are just flat out different from the IRS rules for taxpayers. And I already covered this. Brokers are doing their job right. It's identical positions per the one account. It's a narrow view of wash sales. And the rules for taxpayers are different. It's a broader view. It's substantially identical positions between equities and equity options at different strike prices, dates, and also across all their accounts, joint, spousal, filing joint, and IRA accounts. Now, we do it right because we know the rules correctly. It's sort of like a speed limit on the road that's sort of like blocked by a tree where a lot of people don't see it, but we see it and we enforce it. So we make the tough choices to do it correctly, where a lot of people, industry practice might be that they just rely on the 1099B. They don't look under the hood. They don't deal with it. Maybe that's okay for 10 million investors, but for 500,000 or 1 million active traders, whatever the numbers are out there, in trading in securities, it's not good enough. There's more to deal with it. And every situation is different. And, you know, I talk about the general concepts, but then it comes down to working with clients that Adam and Darren and our full team does. And what I really like about their approach is that it's not one size fits all. We look at what you have, what your broker provides, what makes sense, because we got to sort out whether to go with a software, following the rules right for taxpayers, or try to work with what the broker provides to somehow meld it, or maybe the client doesn't have substantially identical crossover trading. They don't have multiple accounts. Unfortunately, most of our clients do have multiple accounts. So first and foremost, avoid wash sales in the first place. Okay, you have them every day of the year, but break the chain in December. If you sell the position December 20th, don't buy it back till January 21st. That was good to know in December and January. Now it's after that date, and you may have already triggered it, and you didn't even know it until you got a whopping wash sale number on your 1099-B. Another way to avoid it, and this is, we've been educating traders on this since 1997 when they changed the law. Elect mark-to-market accounting, tax loss insurance. It exempts you from the wash sale loss reporting. It's too late for 2019. Now, most people don't know it, but you can trigger a wash sale with your IRA. Take a loss in a taxable account, buy it back in the IRA. That's a wash sale. So use a do not trade list. Trade a lot. I spoke to a client today. He says, Bob, I trade my equities and equity options in my taxable account, but in my IRA, I only do ETFs. There is no crossover. That's a do not trade list. And also get into 1256 contracts. Barron's interviewed me yesterday. They're thinking about advising the retirees in an article to go more into 1256 with all the tax breaks. One is no wash sales. There's MTM, mark to market, built into 1256. So avoid them in the first place. But if you do have them, then you got to deal with it. Now, you might find ways to depart from the 1099-B. Don't take them as the be all and end all of tax reporting. You know, the exchanges are telling brokers whether something's a 1256 or security. They don't like this other world of stuff that falls out of the cracks, like ETNs or CBO listed options on ETNs. So there's all sorts of things that might not be a security subject to wash sales, like VXX, or maybe it's an option on an ETN that could be a 1256 contract, or maybe it's a foreign future. If you get involved with these exotics, then you don't want to just let the 1099 dictate your tax return, and your local accountant may not know these nuances. So you want to stay in touch with our content on those. Oh, excuse me, I went backwards. Now, sometimes you got to make a cost basis adjustment, like if you have a commodities ETF passing through, maybe you didn't get the K1 yet. So don't rush in your tax return. You get the K1. It says you got 5,000 of 1256 pass-through income. Okay, so you pick that up on 6781, but you got to adjust your cost basis, because otherwise you're going to double count that income and overpay your taxes. So you got to sometimes make your own manual cost basis adjustments that are not in the software downloads, not on the 1099-B. You got to piece together all these elements. This is one reason why we only offer our trade accounting service to our tax compliance clients, because we want to see the big picture. We want to see those K1s. We want to know to make those trade accounting software adjustments. So let's bring in my partners again. Darren, Neuschwander. Many TTS traders focus on securities. They're securities traders. So, okay, they're going to trigger a lot of wash sale loss adjustments. How do most TTS traders avoid wash sale problems from arising in the first place? Now, I know I covered the content, but maybe you can personalize it a little bit more with a story. Avoiding them in the first place.
Well, if you really want to avoid wash sales in the first place, you need to consider electing mark-to-market accounting, because if you elect mark-to-market accounting, then you no longer have to worry about wash sales, because that's one of the advantages of using mark-to-market. So that's the first and foremost easiest way to get around having to worry about wash sales. But if you're not in a position to elect mark-to-market, maybe you have what we call tax baggage. Maybe you have some capital loss carryover from prior years, and you want to use that up against current year income, which if you elect mark-to-market, you're not going to be able to do that because you've changed the character from capital to ordinary. You need to stay capital so you can use your current year trading gains to offset that capital loss carry forward. In that case, you will be potentially subject to wash sales. And you just need to be careful. I mean, when we get into that, it's when you get close to the end of the year, look to see what you have sold at a loss, and see if there's anything that you're potentially holding that has a loss that you want to sell. And if you sell those positions, you've got to be real cognizant of what those positions are. And as Bob's already said, you've got to break the chain, which means you don't need to buy any of those positions back for at least 31 days. And that goes forward until the next year. So if you were in December of 2019 and you sold something at a loss, and you think, okay, I'm going to be able to take that loss, you may be surprised when you get your 1099 and see that you've got wash sales, because the wash sale continues to go 30 days into the future. So that's January of 2020. So you got to be sure to break that chain. And there's software that we utilize and recommend that traders use. It's a third-party program, but built inside of that, it'll help you identify potential wash sale items that you have. And I encourage someone that is not marked to market to really utilize that program so that they don't get surprised at the end of the year. And the other word of caution is, if you're trading inside of an IRA and also a taxable account and trading similar instruments, you may be in for a shock when it comes to calculating wash sales. I had a consult yesterday with a potential new client, and he was very concerned about his wash sales on his 1099. But then he told me, I'm also trading inside of my IRA, and I'm trading basically identical positions in my taxable account in my IRA. And I told him, you know what, you may have more wash sales than what you thought you did, because you've got to take your trading inside of your IRA and combine that with your trading from your taxable account to truly get wash sales for the year. That's something that the broker is not required to do. So that's what we do with our clients. This is all we do day in and day out, is work with traders. So we know what you have to do. But again, just to go back to what the original question was, is if you really want to avoid wash sales, consider electing mark to market.
Thank you, Darren. Now, that was good about avoiding wash sales in the first place, but unfortunately, a lot of people are waking up with the mail when they open the 1099-B, the email, whatever, or download. They're shocked to see they might have a big wash sale problem. Some of it could be all year long, but they might have a big problem at year end. So Adam Manning, traders often realize they have a significant wash sale problem after it's too late to avoid them. So at tax preparation time, when they're working with us, when a client shows our CPAs their 1099-Bs and other tax reports, how do we decide on whether to rely on and use the broker statements, or to flip the switch and to use a trade accounting program or service? How do you make that decision? Is it one size fits all? Every client's different? And what's kind of involved with your thinking process?
Well, it's everyone different. As Darren said, if it's an individual and they're trading in a brokerage account and they're also trading their IRA and they're trading positions that are identical, then of course, yes, you're going to have some kind of software to look between those two accounts. Let's say you're just an individual and you're just trading one account individually and that's it, then yeah, you may rely on the 1099-B. Same goes for entities. If you have multiple accounts, you're going to have some kind of software to combine those together to see what wash sales we have between accounts. And just for reference, if someone's just trading specifically futures, then they can just use the 1099-B, and they're fine. There's no wash sale issues there.
Now, Adam, if they have just the one account, but they trade equities and equity options, then I guess they need another solution too, because the 1099-B won't pick up the wash sales between equity and equity options.
Correct.
Excellent. So you wind up with a different solution. Some clients say they have this program or that program, or they've been using this system or that system. And sometimes it's difficult to switch from one 1099-Bs over to a program if there were deferred wash sales from the prior year. So it can be a tongue twister. They really need to consult with experts like our team. Wouldn't you agree?
Oh yes, like we just said, it's case by case. Until we see the facts and know what you have, it's hard to answer that question. But yeah, the more involved it gets, the more you need professional help and a consult to see what your best solution is.
Thank you, Adam. So let's talk about common errors on tax return filings for traders. Traders are unique. Their tax reporting is confusing to many preparers. So again, we have expenses on Schedule C. And I mentioned this before. Some local accountants think, oh, okay, if it's a business, then I can just plop on my proceeds in revenue, my purchases and cost of goods sold, and take that whopping loss on Schedule C. And they try to navigate around the capital loss limitation. Meanwhile, the IRS says there's a big 1099-B. I don't see it reported on 8949. I don't see it on 4797. What's it doing on Schedule C? Guaranteed audit. That's a big mistake. Now, Darren, maybe you want to explain this next slide. You don't have to read the bullet points. Someone's got the red flag on Schedule C. They're a profitable trader. They want the home office deduction. They want the 179 deduction. They want to look better to the IRS. So we've been using this transfer strategy. What's that all about?
Well, as you mentioned, the only thing that really goes on Schedule C is your trading related expenses, and your actual trading gains are either going to be on Form 8949 or Form 4797 if you're a trader. So to fully unlock the home office deduction, you've got to have a profit first from trading. And the way that we're able to help reduce potential IRS notice, especially if you've got a large Schedule C, but you've got trading gains on 8949 or 4797, is we add a footnote to a paragraph to our footnotes that basically explains that we're taking a portion of the trading gains from Form 8949 or 4797 and offsetting them dollar for dollar against the expenses that are on Schedule C. That doesn't change the character because short-term gains are taxed to whatever tax bracket you fall into. Ordinary gains are taxed to what tax bracket you fall into. It's not changing anything from a tax standpoint. It's just more from a presentational standpoint. So, for instance, we had a client that was very successful, had $400,000 of trading gain on Form 4797, but he was a short seller. So he had a substantial amount of what we call hard to borrow fees, and those were totaling close to $200,000 with all of his other trading related expenses. So when you just looked at the face of the 1040, you saw $400,000 gain and a Schedule C with a $200,000 loss. So that's kind of a red flag. So what we did is we transferred at least enough trading gains from Form 4797 to Schedule C to basically equal the expenses he had on Schedule C. And now when the IRS gets the actual 1040 page 1, they see no negative numbers on the 1040. They just see a positive after expense profit of close to 200,000. That is going to have a lot better chance of passing any potential IRS exam issues as opposed to seeing a Schedule C with just negative 200,000.
Thank you, Darren. Now, some people have self-employment tax errors. They transfer too much income to Schedule C, and then the IRS is looking for SE tax, but the underlying income was not earned income. There is no self-employment tax on trading gains unless you're a full-scale member of a futures or options exchange. So don't pay SE tax when you're not supposed to, whether you have 475 or not. And related to that, if your trading gains are unearned income, they're not earned income, you can't deduct health insurance and a retirement plan. You need earned income. That's when we set up the LLC with the S Corp election to arrange the retirement plan and health insurance deduction. And you do pay the Social Security and Medicare, the payroll tax, the equivalent of SE tax, on only the wage portion. So traders don't have earned income, can't deduct health insurance, can't deduct retirement plans, but save SE tax. Now, there's also net investment tax if you're over the Obamacare thresholds of 250 AGI married, 200 single, not indexed for inflation. You're paying the Medicare portion, the 3.8%, on your investment income, your net investment income over the AGI threshold. Don't forget to deduct your trading expenses there. You can't deduct your investment fees and expenses. Now, some people overlook the 1256 loss carryback election. They come to us, they say, I lost 100,000 trading in 2019. We say, was it in securities or futures? And they say it's in futures. And then what do we do, Darren?
If they've got a loss in futures, then we look back to the 3 previous tax years to see if they had any Section 1256 futures gain. If they did, then by default, which is an advantage of trading Section 1256 futures, you have the opportunity to take that loss back, file an amended tax return, and request a refund of taxes that you paid on those Section 1256 gains in any of the 3 previous tax years, taking them in order from the oldest to the newest.
Great. And I'm not sure if too many Lightspeed traders, I don't know if they trade futures, but they may trade outside of Lightspeed. Now, there are errors on entity tax returns too. Adam, you might want to jump in here on this. I know you work with our clients in December going into year end to arrange all the benefits, the compensation, the health insurance, retirement. What do clients get wrong here with that year end planning and then lose at tax time, Adam?
Well, number one is they have to pay the salary to themselves if they want the retirement plan contribution with the entity. That has to be done before year end, and if they want the full solo 401k or mini 401k, they have to set that up before year end as well. Also, for some other deductions with the health insurance, you need to reimburse yourself with an accountable plan before year end, and also be sure that the payroll provider understands and knows the information to report the health insurance on the W-2 when they're prepared in January.
Now, why do you wait until December, Adam?
We normally wait till December because just the way trading goes, you could have a bad year and not need payroll because we normally do not like for clients to pay themselves a salary and do any 401k contributions unless they have net income, that is trading gains and excessive expenses. So you really don't want them paying themselves with their own capital they've already put in, so to speak. So we wait till December, have a big bonus type payroll, and we get together and determine the amount to pay themselves to get to the 401 contribution they want and need.
I like the way you run it through federal withholding and state withholding so they avoid the underestimated tax penalty too.
Yeah, that allows us to catch up there. So we can wait to the end of the year, and if you're underpaid on some of your estimates, you can have it withheld from the W-2 in December there. And the way that works is the IRS sees whatever that withholding is being done quarterly. So it helps catch up on any underpayments you may have.
Thanks, Adam. So now we're sitting here, people are waking up to some of this stuff. They're getting revised 1099Bs. They haven't gotten their K1s yet. Time to file extensions. They're automatic. You get 6 more months to file. October 15th for an individual, September 15th for a partnership or S Corp. Individual tax returns for 2019 are due April 15th. Most active traders aren't ready. Some brokers issue corrected 1099s, still getting K1s, struggling with wash sales. File the automatic extension. It's a simple one pager, but if you don't file that extension, you're subject to a late filing penalty, which is huge, could be 5% a month, up to 5 months. A much smaller penalty is a late payment penalty, but you should pay what you owe to avoid that plus interest. So we have some blog posts that help you on that. I'm updating those blog posts for this year. Those are the ones from last year. We have an upcoming webinar just on these tips as well. So Darren, why do TTS traders file extensions, and what should they focus on for April 15th?
Well, more likely you have just now started to get your 1099s, and you're really just now getting started on tax prep, and that is a compressed amount of time to try to get your tax return into your CPA, get everything filed, make sure all the I's are dotted, the T's are crossed, make sure you got all your expenses within basically less than 2 months. And you can file an extension. It's not an additional cost to file an extension. That's a misconception. It's simply calculating as best as you can how much you owe in tax and paying that in. And we try to be as conservative as we can with filing the extension because we don't want you to be underpaid. So we may not consider all of your expenses when we're calculating the extension. We want you to pay in potentially more. Then when we actually get around to filing the tax returns within the 6-month extension period, that's when we're as aggressive as we can be with the filing. We're looking at all of your expense categories, seeing if you missed something. and making sure that we're taking all expenses that you are eligible to take. And if we take that, then chances are you're going to be overpaid because of what you paid in with the extension. And then you have two options. You can actually have that overpayment refunded to you, or you can request for that overpayment to be applied as part of your first quarter payment for 2020. So that way it kind of protects you of making sure you're paying in for the first quarter of 2020. So, it helps your CPA, it helps you to not compress everything within a time frame where maybe you're just not catching everything. And with the brokerage firms pushing to get their 1099s out, a lot of them sometimes make mistakes, and you'll have to get corrected 1099s. So there again, if you're rushing to get your tax return filed by April 15th, and then you get an amended 1099, well, now you got to consider amending your tax return, whereas if you file an extension, you haven't filed the tax return yet. So when you get those corrected 1099s, it's not a big deal. You just take those into account when you file your final tax returns. So we highly encourage extensions, because that way we have more time to sit down one-on-one time with you in the summer months and make sure that everything that you're eligible to take as a trader, you're taking.
Excellent, Darren. Adam, what's different about filing extensions for partnerships and S corps, which are due March 16th? Is it as elaborate as an extension for an individual, or easier?
No, the entity extensions are much more simplistic. You have a 7004 that you file for the federal. It's just a one-page form. There's no signature required. That's all you have to do to extend it for the federal purposes. For your state, there may be some different items, and that's all case by case on what state you're in. For instance, California has a franchise fee if you're an LLC. And there's some other fees if you're in New York and different states. But basically, it's a lot easier than it is in the situation as an individual. In some of those states, if there is a tax, potentially you may want to make sure you do calculate how much income you have if that tax is based off that income. So, but in regards to the individual, the entity extensions it's much more easy to file and take care of, and it's due in a couple of weeks. So if you have an entity, be sure to file that.
Now, if you're making a 475 election, paper file the extension and staple the election to it, because you can't, isn't it still the case, Darren, that you can't e-file an extension with the 475 election, or has that changed?
No, that's still the case. You cannot put any attachments with an extension that's being e-filed. So if you are electing mark to market for 2020, which will be filed with your 2019 extension, that extension must be paper filed with the mark to market election stapled to it to the IRS.
And the election statement is in our guide, the Green's 2020 Trader Tax Guide, and also some of our other content. So Darren and Adam, if you got to jump now for a hard break, you're all set. Well, I'll finish up with Darren. Thank you, Adam Manning.
All right, thank you.
Everyone else, stay tuned. So Darren, what is our tax compliance service for preparation and planning, and how does it differ from our new Trader Tax Return Review service?
Well, our tax compliance service is basically our tax preparation service. We're preparing your tax return. So if you're a new client, we suggest one or two things. One, a 45-minute consultation, and that way we can address all your initial questions. But if you just feel very confident from the get-go that you qualify as a trader, then you may just want to sign up for our 15-minute new client evaluation. That's a free 15 minutes to just evaluate to make sure we're going to be a good fit for you, and at the same time, you're a good fit as a client of ours. And if we get past that and we move forward, then you sign up for our tax preparation service. And when you sign up for that, our admin team sends you an engagement letter and a very detailed information request. We do everything paperless as much as possible. So you'll upload your information that we request to our share file folder. One of our CPAs will work with you to prepare your return. Every tax return that's prepared is reviewed by another CPA for quality control. A draft of the return is sent to you so that you can review it and address any questions. And then our admin team will bill you for the total time on the job, and then we will e-file the returns with the IRS in the state if you do have a state tax return to file. So that in general is our tax compliance. It's start to finish. We do everything. We do the state returns. If you've got multiple states, we do those also. Our trader review service is something new that we're offering this year. And that is if you have been preparing your own tax return yourself, or you have a CPA that you have a very good relationship with and you don't want to leave, which I can respect that. I always say that if you have a good relationship with your CPA and you don't want to leave, that's great. I hope my clients say the same thing about us. They don't want to leave either. So I can respect that. But if you want someone to actually review that return that has been prepared before you file it, just for more or less a second set of eyes for someone that works in trader taxation day in, day out like we do, that's what this trader review service is for. Sign up for it, upload a copy of the tax return. We may request some of your 1099s, and then we're more or less looking from a top level standpoint to see if the presentation of the return looks reasonable, as if we were filing the return, would we do it this way? And then we give you points back. That can be handled two ways. Ideally, you would get a copy of your tax return from your current accountant, or provide me one before you file it and let me review it before you send it to the IRS. That way, if I have some review points to give you something to change, you can change it before you file it. Otherwise, if you've already filed your return and now want me to look at it and I see, you should have changed this. If you've already filed, then the only way to change is now you got to file a complete separate amended tax return. So that can be some additional time, some additional costs. So again, if you do have a CPA and you don't want to move, or you prepare your own return, that's what that service is. We may be limited on how many of those we can do as we get closer to April 15th. So if that's something you want to consider, I would strongly go ahead and consider signing up for it. And that way we can reserve your spot for it, because more likely as we get closer to April 15th, we're going to have to suspend that service and then pick it back up once we get past the April 15th deadline.
And they can file the extension so they can do it with you after April 15th.
That's
Thank
true
you.
also.
Thank you, Darren. So everyone, here's contact information. Now get your questions up on the board. And I don't know if you've been doing it all along. Darren, I know you've been closely following what I've been saying here. Did you look at the board at all so far, Darren, with the questions?
Yes, I've been trying to address most of them as we come. There's always some good questions. One question that seems to always come up from a webinar, and I'll address it with you again, Bob, and you can answer it, is I don't think I'm going to qualify as a trader individually. So I just want to set up an LLC, because if I set up an LLC, I'm automatically going to be a business, and then I can deduct my trading related expenses.
That doesn't work.
Take the answer.
Yeah, keep in mind, most hedge funds don't have trader tax status, but they're very serious, big operations. So that's a misnomer. It's bad advice. Don't go to an unethical provider that says trader this, trader that for tax, but they don't give you the right advice. They tell you to set up 2 entities when you don't have trader tax status, and not even 1 entity would work, let alone 2 entities. They just want your money. You must have TTS, otherwise you're an investment company. Even with a C Corp, an investment company gets no deductions at all, and there's an accumulated earnings tax. Trader tax status is the starting point. It's the blog on our website. It's chapter 1 of our guide. It's the starting point. Don't try to take a shortcut.
Another question that was asked multiple times today is, should I elect mark-to-market accounting for 2020? But I forgot capital loss carry forward from 2018 and will for 2019 going into 2020. Should I elect mark-to-market for 2020?
Well, there's a lot of decision making in that. And that's what I do in the consultations. And you do too, Darren, when we do those 45 minutes. First, we see if they're a trader for 2020. Yes, they are. We want to see, do you have capital loss carryover baggage? With a capital loss carryover, capital losses for 2019, any unrealized capital losses, do you have baggage? Yes, you do. You have some big baggage. Okay, you need a capital gains ladder to climb out of that hole. Where do you stand year to date, 2020? I'm up big. Okay, skip 475. We'll have capital gains to use up the capital loss carryover. Flip side. No, I'm down big. Okay, let's elect 475 so we don't dig a bigger hole. We have ordinary losses, and maybe we'll have an entity for a do-over to get back to using up the capital loss carryover. All that decision making is in Chapter 2 of Green's 2020 Trader Tax Guide. Pick up a copy on our website. It's $60 with the download in paperback, otherwise $52. Chapter 1, Trader Tax Status, Chapter 2, 475, and all the decision making. This is what you need to focus on before April 15th, not $500 of this expense or that expense. Those you can fill in the blanks on after the extension deadline.
There's also a question, and this is a question I get asked a lot, and it's just a misconception when it comes to the capital loss limitation of $3,000. People think when you have, they hear, okay, you're limited to $3,000 on the capital loss. And that is true, but you have to take into account all of your trading gains and losses for the year. So if you've got short-term capital gain and short-term capital losses, you net all of those together to come to an overall number. And if that number, let's just say, is $10,000, then you can deduct of that 10,000, 3,000 against other sources of income, such as W-2 income, etc. And then you've got a $7,000 capital loss carry forward. But then people seem to think, okay, well, that 7,000, I can only take 3,000 of it next year. Well, that may be the case if you don't have any capital gains at all for next year. But if you trade and have capital gains in the next year of $10,000, well, you get to offset that against your capital loss carry forward dollar for dollar. So in that case, you got $10,000 of gain in the current year, a $7,000 capital loss carry forward. They get to offset dollar for dollar. So in that case, you have a net $3,000 after you've netted everything together, and then you get to take that against other sources of income. And at that point, you have no more capital loss carry forward. So don't think just because I've got an overall capital loss that I'm going to be limited to $3,000 from here on out. That's not necessarily the case if you have capital gain.
And if you set up an entity, the entity can pass through capital gains. The other error we see, Darren, is someone says, I have a huge capital loss carryover, but I only entered 3,000 this year because that's all I could use. They were wrong under the terms you just said, or that's all they had that year. And then they're saving the rest of it for the next year. And we try to tell them, you just kissed it goodbye. If you don't continue the string of that reporting, after 3 years, the return closes and that loss is gone. You must report all your losses and let Schedule D do its work.
Mm-hmm.
So everyone can come back over to the website. Here's a picture of it. And I can also end the show and bring up the website over here as well. Darren, what are the questions and answers before we stop?
There's a lot of questions about individuals that should they, and I know Adam addressed this, but I'll just reiterate it. If you're already using mark-to-market, should you tell your broker that you're using mark-to-market so they can report it using mark-to-market? Our suggestion is no on that. And the reason for that, I can give a true life example to that. Another brokerage firm, my client, unbeknownst to me, told the brokerage firm that he qualified as a trader and he elected mark-to-market, and he wanted his 1099 reported using mark-to-market accounting, which they did. And he qualified as a trader for 3 years in a row, and we were able to use that 1099 and it was fine because it was already on mark-to-market. But he was not able to qualify as a trader in current years. And he went back to the brokerage firm and said, I don't qualify as a trader. I want my 1099 reported back the old way with cash basis using wash sales. The brokerage firm said, we can't do that. We can't go back to the old way. So he was in a predicament because in that case, he couldn't use his 1099 because it didn't calculate wash sales. And the broker basically told him the only option he had was to close that particular account and set up a brand new account. And that wasn't the most feasible thing to do either. So That's why we don't suggest you tell your broker that you're using mark-to-market accounting. Continue to let them to report it by the default way, and then use accounting programs such as we use one that's called TradeLog as a third-party program, and then it will do the gain and loss calculations for you using mark-to-market accounting. That's the more appropriate and safe way, especially if you may or may not qualify as a trader 1 year to the next, because that's another misconception. Once I qualify as a trader, I'm always a trader from there forward. That's not true. Each year stands on its own. So you have to qualify as a trader year after year to be able to take the benefit of it.
There's so many nuances, Darren. I'm really hoping that new Trader Tax Return Review Service fills in the blanks for the people who don't quite make the move to use us fully, but still need our help for key issues. I think that's a nice filler for us to round out our offering. Any final questions that are interesting for everyone else to hear, Darren?
Well, this is kind of a question I think would be good for you, Bob, because it usually doesn't happen this way. Usually people come to us after the fact, but this particular individual in the group today said, I'm just getting started in trading in 2020. This is my first year. What should I do? So what would you suggest in that aspect?
Well, if they're going to qualify for trader tax status, so they expect to graduate from university this year, Q1, Q2, Q3, and they know that they want to go to grad school 475, they got to file that election on time. So I'm going to interview them to see if they qualify for TTS. I'm going to see if they have capital loss carryover baggage, if they're trading securities, because we're only recommending 475 on securities only to retain the lower 60/40 capital gains rates on 1256 contracts. And if that's the case, maybe they're going to elect as a sole proprietor. So next I say to them, what are you doing about health insurance? Do you have it in a job or through a spouse's job? No, you're paying for health insurance on your own, and it's a big number, $1,000 a month, $2,000 a month for the family. If you're profitable, do you want to have a retirement plan contribution, a high deductible one like a solo 401k? Yes, I do. I need health insurance deduction, and I need solo 401k. Okay, then let's set up an LLC with S Corp election to start your trading business in that. Let's go through the costs versus the benefits versus the savings to see if it's a good move to make. And that entity can make the 475 election. In that case, you may or may not need the election as an individual. So this is exactly what we do in the consultations, Darren. We work with people on their 2020 planning to set things up right from the start.
So Bob, would you say that we have one package for everybody, or is it really based on their own individual circumstances?
Well, we have a package of knowledge in this unique area, the law, that every client has a different application of it because their needs are a little different. Like, for example, a lot of clients don't need a health insurance deduction. They don't really quite make enough money to want a retirement plan deduction. They're in a state where the S Corp can cost a little more money, like California with the 1.5% franchise tax. We do the cost benefit analysis and we say, no, stay a sole proprietor. So it depends on state, marital status, how much money you're making. Do you have another job? What your goals are. So a lot of things need to be taken into consideration.
And I guess what I'm trying to get from what he just said for those that are with us today is an entity. We don't go in from day one saying everyone has to have an entity. That's just not the case. So some of the questions said in the webinar today is, do I have to have an entity? And I can't tell you yes or no on that. That's based on your own individual facts and circumstances. Maybe it makes sense for you, maybe it doesn't, or maybe it doesn't make sense for you right now, but it can in the next year or a very short time frame from now. And that's what sets us apart from some of our competitors, is that we don't have a one shop fits everybody. We don't go from day one saying you need this multiple entity structure. We want to look at what's best for you and your own individual facts and circumstances. And that's what's different about our firm, is we want to get to know you and what's going to be the best strategy for you.
That's why we break out the consultation from the entity formation, because about half the clients that come to us wanting an entity, we talk them out of the entity for now. Maybe they'll grow into it next year. So we do the 45-minute consultation, handle everything, have a plan. And afterwards, if the entity makes sense and we know what kind it should be, then they sign up for the entity formation service.
I think that covers most of the questions that we had just in general, Bob.
Great. Well, let me just go back to the dialogue. And Rob, I'm going to pass it back to you. Everyone, before I do, come to our website. There's contact us. Phone is not the best way to deal with us. Email is, because our team is very busy in tax season and we don't have people just sitting on the phone that aren't capable of giving you great answers. It's better by email. I answer a lot of those. Sometimes Darren does some of the chat, but email is best. And follow up with us. We want to help you. And thank you very much to Lightspeed and you, Rob. Thank you, Darren Neuschwander, my partner. Thanks to Adam Manning, my partner, who already left. And I'm Bob Green, and we hope to hear from you soon, everyone.
Thank you, guys. We appreciate it very much. The recording will be available on our website and our YouTube channel within a couple of days. So certainly I could also send it over to you as well. We certainly appreciate you presenting and providing this information, guys. I hope you really got some useful info here, and thank you for answering some individual questions as well. We really appreciate it. Just to do our quick raffle here, I just had picked a name, and actually it was Braden H. Braden H, you actually won the duffel bag. So just shoot me an email to confirm your address, or call in and ask for Rob, and I'll be happy to give that over for you. So congrats there. And guys, thank you very much for attending. Look out for our other webinars as well coming up, and look out for this one to be on our website within a couple days. So have a great night, everyone, and thank you very much.